So, welcome everyone, there we go, backwards. Welcome everyone to our market update. I am very excited to be here with you, my first time presenting here at Te Pai. So, with my excitement disclosed, we can get into it. I'm going to talk to you about investment market returns. I'm then going to talk to you about recent bank failures in the US, and then I'm going to talk to you about the R word, that's recession, and what that might mean for investors. This is the performance of various asset classes or investments over the last 12 months ended 28 February 2023. This is the growth of $1 if you'd invested 12 months ago. Leader of the pack in yellow is Australian shares, where $1 invested 12 months ago would be $1.08. In second place, in orange, is global infrastructure, where $1 invested 12 months ago would be $1.06. In third place, in green, is cash. That $1 would have turned to $1.03. After the metals, it starts to look a bit grim. Other than international shares unhedged in Navy, which just at the end of February peaked its way back above $1, everything else is negative. That's a tough year. A 50-50 mix of shares and property and cash and fixed interest would have declined in value to 96 cents. As I said, not a particularly good year. However, I always say that 1 year is never long enough. You need at least 3 years' data. This is the same slide now over 3 years rather than one. The leader this time is unhedged international shares in Navy, where $1 invested 3 years ago would have grown to $1.32. Pipped into second place this time is Australian shares, where $1 invested 3 years ago would be $1.31. In third place, in orange, is global infrastructure, where that $1 would have turned into $1.14. In fourth place is a 50-50 mix of shares and property and cash and fixed interest, which would have grown to $1.08. Now that's about double what would have happened to cash in green, which would have turned to about $1.04. Now, those of you that like a bit of math, and I disclose that's me, would actually be able to figure out that that $1.08 amounts to about 2.6% per annum. That's even though that's double the return of cash over that time period, that's not a great reward for that amount of volatility. But that's 3 years. What about over 5 years? Same slide, this time the growth of that $1 invested 5 years ago, not 3. Now, this looks like a slightly better story. Every asset class on this slide is positive, albeit some of them only just. At the very bottom there, it's international fixed interest hedged to the New Zealand dollar. It's only just above $1 at about $1.02. But at the very top, in Navy, is unhedged international shares, where $1 invested 5 years ago would be $1.62. That 50-50 mix of shares and property and cash and fixed interest, now that would be worth over $1.20. Now that's an annualised return of a little over 4% per annum. That $1 invested in cash, that would be worth $1.07. Now that about 2% extra per annum return, that's reward for patience and discipline, at least over this time period. Now, very recently, last week in fact, 2 banks in the US failed. Silicon Valley Bank, so named for its preponderance of tech companies in Silicon Valley, failed. Not good news. Signature Bank, a regional bank in New York, same thing happened. Now, the reason for these failures is really interesting. It's actually a really old-fashioned reason. It's a run on the bank. This is the sort of thing that caused lots of collapses in the Great Depression, when people were concerned about the bank's ability to give them their money back, so in they walked and took it. This time, of course, it was all electronic. Now, the reason that this got quite a lot of news in New Zealand, apart from being a reasonably slow news week, is that 4 New Zealand companies had money in Silicon Valley Bank. Comvita, Xero, Ike GPS and Rocket Lab all had various sums invested in Silicon Valley Bank, from as little as 2.5 million to as much as 62 million. Now, at the beginning of last week, that was a big problem. The Federal Deposit Insurance Corporation guarantees all investments in US banks up to $250,000 US dollars. That's about 407,000 New Zealand dollars. Now, that's not great if you've got 62 million invested. However, a few days later, it wasn't such a big problem, at least not for depositors, because the Federal Deposit Insurance Corporation, the Federal Reserve, and the Treasury, that is the US government, stepped in to ensure that all deposit makers get all of their money back. So those four New Zealand companies and everyone else who had money in Silicon Valley Bank and Signature Bank all got all their money back. In fact, Treasury, the Federal and the FDIC and the Federal Reserve all then undertook programs to refloat or sell those banks. The interest in Silicon Valley Bank was so large that the FDIC had to build a book. That is, they had to go out to market and say, give us your expressions of interest in refloating this bank, because the nature of the relationships there was so valuable. Signature Bank actually had almost all of its assets bought by a rival last week. Now, banks are scary, or at least bank failures are scary. So if we think about what that means, actually, it's not that unusual. The US bank market is very different from the New Zealand bank market. The US bank market is fragmented and very regional. It has a long history of bank failures. Going all the way back to the Great Depression, there were 9,000 bank failures in the Great Depression. That actually led to the emergence of the Federal Deposit Insurance Corporation, FDIC, which was developed by Franklin Delano Roosevelt as part of his New Deal. But that wasn't the last time they had massive failures. In the 1980s and 1990s, over 1,000 banks failed in what was called the savings and loan crisis. The FDIC stepped in a lot there. In the GFC, the largest bank failure of all time, Washington Mutual, at 17 billion, failed. 500 other banks did as well. In the period running up to the GFC, that is 2001 to 2007, which was a golden time for banking. That was when Alan Greenspan was governor of the Federal Reserve, and his motto was go for growth. That meant easy monetary policy conditions and low capital requirements for banks. Really good time to be a banker, 25 banks still failed. In 2020, when the federal fiscal monetary policy conditions were the most generous they have ever been, there was more money and it was cheaper than it's ever been in the history of time, there were still 4 bank failures. The fact that there were no bank failures in 2021 and 2022, that was unusual. That's the first time there have been 2 years of consecutive no failures in the US banking system in decades. So not pleasant, but actually not that unusual. What about the size of the 2 banks? Because they were big failures. Silicon Valley Bank was 6 billion. Signature Bank was 4 billion. Those are big numbers. And in a nominal sense, those are the second biggest and third largest failure of a bank in the United States in history. However, since 1929, the size of the US economy in terms of gross domestic product, or GDP, that's the sum of everything that that country makes, has grown from $0.11 trillion in 1929 to $23 trillion as at the end of 2021. New Zealand's GDP in US dollar terms last year, $250 billion. That's a bit humbling, isn't it? So while 6 billion is a really big number, it's 0.003% of the total size of the US economy. Now that doesn't mean, and I don't wish to be flippant, that it doesn't matter. It does. And if you were a shareholder in Silicon Valley Bank, at least a large shareholder, that'd be pretty upsetting. Maybe less so for diversified investors, but I'll come to that. So Silicon Valley Bank was in fact the 18th largest bank in the United States. So what does that mean if you have a portfolio that holds lots of individual securities? Well, you probably had it. And in fact, if you're a client of Cambridge Partners, yes, you did. You had it in your portfolio. It represented 0.03% to 0.04% of around about 20% of your portfolio. I apologise for all the percentages. What that actually means is that in your portfolio, you had 0.006% to 0.008% exposure to Silicon Valley Bank. Now, the reason that I put this as being not such a big deal, and I don't mean to minimise again, is that there's one fund manager out there that had a very large exposure to Signature Bank. To our knowledge, we had none. They had 80 million invested across their client portfolios. In one of their funds, it was 4.81%. That's 4.81% that has disappeared, relative to 0.03 or 0.04% in the funds that our clients have got invested. That's diversification. That's why in our underlying portfolios we have between 6,000 and 9,000 underlying exposures, because we don't know where the next Silicon Valley is going to be. We do know, by the way, that if you have the other, 99.97% of your portfolio invested in a diversified mix of other assets, that you would have done well. The S&P 500, which is the main index in the United States, the one that Silicon Valley Bank is in, that's actually up 1.5% in value since Silicon Valley Bank failed. So, if you held a diversified portfolio and Silicon Valley Bank was in it, you're actually up. That's most of our clients, by around about 0.07%. Interesting. I'm going to change tack now and talk about recessions. So to begin with, what is a recession? There's been a lot of talk about it lately, and I thought it would be useful for us to A, define it, and then talk about what it might mean for you as investors. A recession is a significant, widespread and prolonged downturn in economic activity. Now, experts usually define a recession as 2 consecutive quarters of negative economic growth. And those are the words, by the way, isn't that terribly academic? 2 consecutive quarters of negative economic growth. That's a decline, isn't it? That's a contraction. So we'll use that. So two consecutive contractions in GDP. Now the problem with defining a recession is that it takes a long time to happen. 6 months of actual negative data, another month and a bit, or if you're in New Zealand, 2 months and a bit, before you actually get any information that tells you that you are in a recession. But what might that mean? Well, that means we should look at other indicators that will give us some indication that we're in a recession. One indication that people talk about is bear markets. Now, a bear market is a fall of 20% from peak to trough of investment markets. Most investment markets around the world, that includes New Zealand, entered bear market territory in June last year. One postulated idea is that bear markets predict recessions. Since 1929, there have been 15 recessions in the United States. Bear markets have predicted 26 of them. So no, bear markets do not predict recessions. What about economists? That's their job, isn't it? Last week, New Zealand economists from the Big Five, ANZ, ASB, BNZ, Westpac and Kiwibank all predicted that the New Zealand economy might have 1 foot in recession with negative growth in the December 2022 quarter. They were correct. Stats NZ released their numbers on Thursday of last week, and New Zealand economy shrunk by 0.6% in the December 2022 quarter. None of the economists got the number right, but they were all directionally accurate, so that's something. However, last year, I tested John Kenneth Galbraith, who's an infamous economist, whose main proposition was that the only function to economic forecasting is to make astrology look respectable. Now, I tested that premise last year by testing the economist predictions for the official cash rate at the end of the year against an astrologer's prediction for me. The astrologist did a better job. So maybe the economists can signal a recession, but based on the evidence, probably not. So we don't know if we're in recession. But if we were, what might that mean for investment markets? It's more interesting. So, what I've done here is I've analysed the returns from the S&P 500, that is the largest stock market index in the US, since 1945, during periods of recession and the year after. It's been a really interesting exercise. 13 recessions over that time period. Actually, during the time period of a recession, stock markets went up. Not a lot, by on average 1%, but they went up. Now, the year's slightly different because recessions typically don't last a year. Here's the data. And what it shows is that about half the time, stock markets go up, and half the time, stock markets go down. Actually, that's about right. It's probably 57%, 43%, but in recessions, that's what happened. The average return from the S&P 500 over the 12 months that included a recession was negative 1.1%. Now, that data is skewed by a couple of events. In 2008, the global financial crisis, if we exclude that number, or the 1974 oil shocks, either number gets excluded, the average becomes positive. They both get excluded, the average becomes about 6%. The average over the total investment period from 1945 to 2020 was 10.9% per annum. What's interesting is that the returns in the year after a recession were almost universally positive and outsized. The average return from the year after a recession was 16.9%. That's more than 6% higher than the long run average. Now, what's interesting is when those returns come, because that's much more difficult to show, but typically they come just after an economy has exited recession. What that shows is that trying to pick when to be out of markets and trying to pick when to be in is really difficult. The average return over all those 26 years was about 8%. That's pretty close to the long run average. If you take out the GFC in 2008, it's 10%. That is the long run average. So, what can we conclude from that? Good question. Discipline, patience, and not reacting emotionally to what the news media suggests to us are rewarded over time. Banks, all companies, in fact, sometimes fail. The key is to taking a diversified approach to your investment strategy. So you've got exposure to thousands of them rather than tens. If one company fails and it represents 0.006% of your portfolio and the remainder goes up, that's okay. If one company fails and it represents 4.81% of your portfolio, that's pretty distressing. Over the long run, investments will perform. You will be rewarded for your discipline. Thank you for listening.